studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
For many years, dividend planning in private corporations often involved paying dividends to family members who own shares of the company. As long as the shares existed and the legal requirements were met, dividends could frequently be distributed among spouses and adult children to reduce the overall family tax burden. However, the tax landscape changed dramatically with the introduction of the tax on split income rules, commonly known as TOSI. Under the old approach, ownership alone was often enough to support dividend payments. Under the new rules, ownership by itself is generally no longer sufficient. The Canada Revenue Agency now expects that dividend payments to family members can be justified based on their actual involvement or contribution to the business. This means that when dividends are paid to a spouse, an adult child, or another related individual, the question is no longer simply whether they own shares. The more important question is why they are receiving the dividend in the first place. The government introduced these rules to prevent income splitting arrangements where family members received dividends primarily to reduce taxes, even though they had little or no involvement in the business. As a result, dividend planning today requires a much more careful analysis. Tax advisors must consider whether the individual contributed labor, invested capital, assumed financial risk, participated in management, or otherwise meets one of the available exceptions under the TOSI rules. If the requirements are not met, the dividend may be subject to TOSI. When TOSI applies, the income can be taxed at the highest marginal personal tax rate, eliminating many of the intended tax benefits. The key takeaway from this slide is simple. The rules have changed. Simply owning shares is no longer enough. Modern dividend planning requires a genuine connection between the individual and the business, supported by facts, documentation, and a valid reason for receiving the dividend. This slide captures the single most important concept behind the tax on split income rules, or TOSI. Before looking at detailed exceptions, tests, and technical rules, it is essential to understand the question that drives the entire TOSI framework. That question is simple. What did this person contribute to the business? When a family member receives dividends from a private corporation, the Canada Revenue Agency wants to know why that individual is receiving those dividends. The answer must be supported by a meaningful contribution to the business. One possible contribution is labor. Did the individual actually work in the business? Did they contribute time, skills, effort, or expertise that helped the company operate and grow? Another possible contribution is capital. Did they invest their own money into the corporation? Did they provide funds that helped support the business and assume the financial risk associated with that investment? Risk is another important factor. Some individuals personally guarantee loans, pledge assets, or expose themselves financially to help the corporation succeed. Taking on real financial risk may support a claim that dividends are justified. Management involvement can also be relevant. Did the person participate in strategic decisions, oversee operations, serve as a director, or help manage the business in a meaningful way? These contribution factors form the foundation of modern dividend planning. The more evidence there is that an individual contributed labor, capital, risk, or management involvement, the stronger the argument that dividends paid to that person should receive normal tax treatment. On the other hand, if there is little or no meaningful contribution, the dividend may fall within the TOSI rules. When TOSI applies, the income can be taxed at the highest marginal personal tax rate, significantly reducing or eliminating the intended tax benefit. The key takeaway is that every TOSI analysis begins with one question: what did the shareholder contribute to the business? If you remember that principle, understanding the detailed TOSI exceptions becomes much easier. Now that we understand the core principle behind TOSI, we can simplify the entire decision-making process into a single framework. The starting point is straightforward. A shareholder receives a dividend from a private corporation. At this moment, the tax advisor should not immediately assume that the dividend qualifies for normal dividend tax treatment. Instead, the first question is whether the shareholder made a meaningful contribution to the business. If the answer is yes, the analysis continues. A meaningful contribution might include working in the business, investing personal capital, assuming financial risk, participating in management decisions, or contributing in another significant way. When meaningful contributions exist, the shareholder may qualify for one of the TOSI exceptions that we will study later. If an exception applies, the dividend is generally taxed under the normal dividend taxation rules. This is the outcome most taxpayers hope to achieve. However, if the answer is no, the situation becomes much more difficult. If the shareholder has not worked in the business, has not invested meaningful capital, has not assumed financial risk, and has not been involved in management, then the dividend may fall within the TOSI rules. When TOSI applies, the dividend loses much of its tax planning value. Instead of benefiting from income splitting, the income may be taxed at the highest marginal personal tax rate. In many cases, this eliminates the intended tax savings entirely. This is why experienced tax practitioners often think of TOSI as a process of proving an exception. The starting assumption is not that the dividend automatically qualifies for favorable treatment. The analysis begins by asking whether there is enough evidence to support an exception. As you continue through the TOSI rules, you will encounter several specific exceptions, such as the excluded business test, the excluded shares test, and the reasonable return test. Although these rules may seem complex, they all stem from the same underlying question: did this person contribute enough to justify receiving the dividend? The key takeaway from this framework is that TOSI is not about ownership. It is about contribution. The more clearly you can demonstrate meaningful involvement in the business, the stronger the case for avoiding the TOSI rules and preserving normal dividend tax treatment.